Most people think that when inflation starts cooling, the next step is obvious. Interest rates come down, borrowing gets cheaper, and households finally get some relief. But the reality is more complicated. If you're a homeowner, a retiree living on a fixed income, a worker trying to build savings, or simply someone carrying debt, the latest inflation report matters to you, but not necessarily for the reason you might think. There is a financial shift quietly developing in America right now. Inflation has eased, but it has not disappeared. The Federal Reserve has stopped raising rates for now, but some policymakers still believe rates could need to move higher, and financial markets are already trying to predict what happens next. That creates a very important question. If inflation is cooling, why isn't the Federal Reserve already cutting rates? And more importantly, what would a rate cut actually mean for your mortgage, your savings, your investments, your retirement, and your everyday budget? Once you see the numbers clearly, you'll understand why this matters more than most people realize. The latest U.S. inflation report gave financial markets a reason to breathe a little easier. Consumer prices increased just 0.1% in July on a year-over-year basis. Headline CPI increased 3.4%, down from 3.5% in June. Core CPI, which excludes food and energy, increased 0.2% during July and was up 2.5% from a year earlier. At first, those numbers sound straightforward. Inflation is coming down, but here's the part that matters. The Federal Reserve's long-run inflation goal is 2%. At 3.4%, headline inflation is still well above that level. So, this isn't the end of the inflation story. It's evidence that some of the pressure is easing. And that difference is extremely important. Think about it this way. Imagine your household expenses have been rising for several years. Then, suddenly, the rate at which those expenses are increasing slows down. That doesn't mean your grocery bill, rent, insurance, or healthcare costs return to where they were years ago. It simply means they are rising more slowly. That is essentially where the American economy stands. Inflation has cooled dramatically from its earlier extremes, but the overall price level remains elevated. And that's why the Federal Reserve has to be careful. The Fed isn't trying to make prices fall across the entire economy. It is trying to bring the rate of price increases back toward a level consistent with price stability. That's a much harder task than simply waiting for prices to decline. Now look at what is happening underneath the headline. Gasoline prices fell 2.9% in July, helping keep overall inflation contained. Shelter costs increased 0.1%, while food prices rose 0.1%. Some other categories also contributed to the monthly increase, including healthcare, airline fares, and technology products. For a typical household, this means the inflation experience isn't uniform. If you drive a lot, lower gasoline prices may provide some relief. If you're renting or paying housing costs, that relief may be less noticeable. If you're buying technology products or dealing with healthcare expenses, you may see a completely different inflation experience. And this is one reason people can hear that inflation is cooling while still feeling that life is expensive. Both things can be true at the same time. The inflation rate can decline while the cost of living remains much higher than it was several years. To go walk, that brings us to the Federal Reserve. At its July meeting, the Fed kept the federal funds target range at 3.50% to 3.75%. The decision passed by a 9-3 vote, with 3 policymakers preferring a quarter-point increase. That vote tells us something important. The Fed is not united around the idea that rates are already low enough. 3 policymakers wanted higher rates. At the same time, the majority chose to wait. And waiting is important because monetary policy works with a lag. A rate increase today doesn't instantly change every mortgage, business, loan, hiring decision, or consumer purchase. Its effects can take time to move through the economy. So the Federal Reserve has to look ahead. It has to ask whether today's policy is already restrictive enough to bring inflation down without causing unnecessary damage to economic activity. That is the balancing act. And right now, the latest inflation data give the Fed another reason to watch rather than immediately tighten. Markets reacted accordingly. After the July CPI report, expectations for a September rate hike declined. Reuters reported that market pricing put the probability of a September hike around 38% following the data. But here's where many investors make a mistake. They hear that the odds of a rate hike have fallen and immediately conclude that a rate cut is coming. Those are not the same thing. The Fed can choose a third option. It can simply leave rates unchanged. And right now, that is a very realistic possibility. The Federal Reserve's September meeting is scheduled for September 15th and 16th. Between now and then, policymakers will receive additional information about inflation, employment, consumer spending, financial conditions, and economic growth. So today's inflation report is not the final answer. It is another piece of evidence. And this is where most households should stop trying to predict the exact date of a Fed move and start thinking about something much more useful. How prepared are you if rates stay high for longer than expected? Because this is where most people get caught. They build a financial plan around one forecast. They assume rates will fall. They assume the housing market will become cheaper. They assume stocks will keep rising. They assume savings rates will stay attractive. And then the economic environment changes. A strategic household doesn't need to predict the future perfectly. It builds enough financial margin to handle several possible futures. Consider someone in their 30s carrying high-interest debt. For that person, the most important question isn't whether the Fed cuts rates by a quarter percentage point in September, it's whether they can reduce expensive debt and improve monthly cash flow regardless of what the Fed does. Now consider someone in their 50s who is approaching retirement. Their priority may be different. They need to think about how much of their retirement portfolio depends on continued stock market gains, how much cash they need for near-term expenses, and how inflation affects their future purchasing power. And if you're already retired, the issue becomes even more personal. Inflation can quietly reduce the purchasing power of a fixed income. At the same time, falling interest rates could eventually reduce the yield available on cash and short-term fixed income investments. So a retiree can face pressure from both sides. Higher inflation reduces purchasing power. Lower rates can reduce income from conservative savings. That is why the answer isn't simply, rate cuts are good. Rate cuts create winners and losers. They can help borrowers while reducing returns available to some savers. They can support asset prices while potentially creating new valuation risks. They can make financing easier while also signaling that policymakers are responding to weaker economic conditions. Context matters. Now let's talk about the two paths households can take from here. The reactive household waits for the Federal Reserve to make the first move. If rates rise, they worry. If rates fall, they celebrate. If stocks rise, they buy because they don't want to miss out. If stocks fall, they sell because they don't want to lose more. Their financial decisions are driven by headlines. The strategic household works differently. They understand that they cannot control the Fed. They cannot control inflation. They cannot control treasury yields. They cannot control the stock market. But they can control their debt, emergency savings, spending structure, diversification, and long-term investment behavior. That difference may seem small today. Over 10 or 20 years, it can become enormous. This is the compounding effect of financial decisions. A household that consistently maintains a reasonable savings margin, avoids unnecessary high-cost debt, and keeps its investment strategy aligned with its time horizon doesn't need every economic forecast to be correct. It simply needs to avoid being forced into bad decisions at the wrong time. And that brings us to another important issue. The latest inflation report does not mean the economy is completely out of the woods. Reuters noted that inflation-adjusted wages declined 0.2% year-over-year in the latest report, while the labor market has also shown signs of weakening. That creates a difficult combination. If inflation remains elevated, the Fed has a reason to stay restrictive. But if employment and real household income weaken, the Fed has a reason to be cautious about keeping policy restrictive for too long. This is the tension policymakers are dealing with, and it explains why the next few economic reports could matter more than today's headline. Imagine two possible futures. In the first, inflation continues moving gradually toward 2%. Employment remains reasonably healthy, and economic growth continues. That would give the Federal Reserve room to eventually reduce rates without feeling that it is abandoning the fight against inflation. That is the relatively comfortable scenario. But imagine another path. Inflation stops falling, energy prices rise, core inflation remains stubborn. At the same time, economic growth weakens. Now the Fed faces a much harder decision. Cutting rates could support the economy, but it could also risk keeping inflation elevated. Keeping rates high could help contain inflation, but it could place additional pressure on growth and employment. This is why you shouldn't build your financial plan around a single Fed meeting. Instead, there are several things you can do this week. First, look at your household's fixed monthly expenses. Add up housing, insurance, utilities, transportation, minimum debt payments, and other costs that you cannot easily eliminate. Then compare that number with your reliable monthly income. You are looking for margin. The larger the gap between essential income and essential expenses, the more flexibility your household has when conditions change. Second, examine your expensive debt. If you're carrying variable rate debt, understand exactly what interest rate you're paying and how much that debt costs you each month. Don't wait for a Fed rate cut to start improving your balance sheet. A lower debt burden gives you more financial flexibility, regardless of what policymakers do. Third, review your cash reserves. You don't need to chase every headline about where interest rates are going. The basic question is whether you have enough accessible money for unexpected expenses without having to sell long-term investments at an inconvenient time. Fourth, look at your investment allocation. This isn't about trying to guess whether stocks will rise or fall next month. It's about asking whether your portfolio still matches your time horizon and ability to tolerate losses. Someone with decades before retirement can generally approach market volatility differently from someone who needs the money soon. Fifth, if you're approaching retirement, revisit your income plan. Don't simply ask how large your retirement account is. Ask how much you actually need each month, which expenses are essential, and how your income sources interact with inflation. Social Security, pensions, investment income, cash reserves, and withdrawals all play different roles. And sixth, pay attention to taxes. A lower interest rate environment can change investment income, bond returns, refinancing decisions, and other parts of a household's financial picture. Tax planning should be based on your actual circumstances and current IRS rules, not a generic internet forecast. The broader lesson is simple. You don't need to know exactly what the Fed will do to make a better financial decision this week. You need to understand how sensitive your household is to changes in rates and inflation. That is structural awareness, and structural awareness is often more valuable than prediction. Now, there's another psychological trap worth discussing: loss aversion. People tend to feel losses more strongly than equivalent gains. That can make investors react emotionally when markets move. But the Federal Reserve's decisions aren't designed around your portfolio balance. They're designed around the broader economy. So if the Fed keeps rates high, that doesn't automatically mean you should become pessimistic. And if the Fed cuts rates, that doesn't automatically mean you should become aggressive. The right response depends on your financial position. A 30-year-old with stable income and a long investment horizon may have very different priorities from a 62-year-old preparing to claim Social Security or a retiree relying heavily on investment income. Your age matters, your cash flow matters, your debt matters, your tax situation matters, your time horizon matters, and your ability to absorb financial shocks matters. That's why the same economic news can be good news for one household and relatively neutral news for another. Let's step back and look at the bigger picture. The United States isn't facing a simple inflation is over moment. It's facing a transition. Inflation has moderated. The Fed has paused. Markets are debating whether the next major move will eventually be lower rates. But the central bank still has a 2% inflation objective, and July's 3.4% headline inflation rate remains above it. That means patience matters. For investors, patience means avoiding the temptation to turn every economic report into a trading signal. For homeowners, it means not assuming that mortgage rates will suddenly collapse. For savers, it means recognizing that today's yields may not last forever. For people carrying debt, it means using today's environment as motivation to improve cash flow, rather than waiting for perfect conditions. And for people approaching retirement, it means building a plan that can survive different combinations of inflation, market returns, and interest rates. The most important financial advantage isn't predicting the Fed. It's having enough flexibility that you don't have to, because the households that build wealth over long periods are rarely the ones that correctly predicted every economic turning point. They're often the ones that maintained good habits through all of them. They saved when markets were exciting. They stayed disciplined when markets were frightening. They managed debt when borrowing was expensive. They avoided unnecessary risks. And they gave their money enough time to compound. That's the long-term perspective that can get lost when every morning brings a new headline. Right now, inflation is cooling, but the Federal Reserve hasn't declared victory. The September meeting is still weeks away. The next inflation and employment reports could change expectations again, and the possibility of a rate cut remains a question, not a promise. So instead of asking, "What will the Fed do?" a better question may be, "What would happen to my household if rates stayed high for another year?" And then ask the opposite. What would I do if rates eventually fell? If you can answer both questions calmly, you're already in a stronger position, because financial stability isn't about knowing the future. It's about preparing for more than one possible future. And that is what makes this inflation report important. Not because it guarantees a rate cut, not because it guarantees a stock market rally, and not because it means the inflation problem is finished. It matters because it shifts the balance of probabilities. The immediate pressure for another rate hike has weakened. Markets are beginning to look more closely at the possibility of eventual easing, but the Fed still needs evidence that inflation is moving sustainably toward its 2% goal. Until that evidence becomes stronger, policymakers have every reason to remain cautious. For households, the message is surprisingly calm. Don't panic. Don't become complacent. Don't make a major financial decision based on one CPI report. Instead, strengthen the things you can control: your spending, your debt, your cash reserves, your investment allocation, your retirement plan, and your understanding of how inflation affects your future purchasing power. Because whether the Fed eventually cuts rates in September, later this year, or much further down the road, those decisions will matter far less if your household is already financially prepared. The economy changes, interest rates change, markets change, but strong financial habits can remain remarkably consistent. And over a decade or two, those habits can matter much more than one headline. So here's the question I want to leave you with. If the Federal Reserve eventually cuts rates, what would have the biggest impact on your finances? Your mortgage, your savings, your investments, your debt, or your retirement plan? Share your answer in the comments. And if you want calm, data-driven explanations of inflation, Federal Reserve policy, retirement, taxes, housing, and the U.S. economy without the unnecessary hype, consider subscribing. Because the goal isn't to predict every market move, the goal is to understand what's changing, understand what it means for you, and make better decisions before the next headline arrives.